I'm Justin Reid. I'm the CEO of Troilus Gold. We're developing the Troilus copper gold asset in Northern Quebec. Feasibility is done, permitting is well advanced. It is going to be a 22-year mine minimum, producing over 350,000 ounces of gold equivalent per year.
Good to see you, Justin. Good to see you. And probably off the back of some, quite good news. You have put a release into the market talking about a sort of syndicate of global lenders to the tune of $700 million on top of the already 1.3 million on from the Export Credit Agency. So tell us about that, and if you don't mind, get into the kind of some of the terms and conditions around that.
Sure. As we've spoken about in the past, in November, after about 6 months of work, we accumulated over a fairly short period about 1.3 billion of LOIs, right? Letters of intent, essentially letters saying that if we do X, they will commit to X. And the majority of them were around raw material guarantees, meaning that we would supply copper and gold concentrate into various refiners in the European Union, namely Germany, Sweden, and into Finland. That was going to be backed and matched by the Canadian government through Export Development Canada. They all had various, $500 million from Euler Hermes in Germany if we gave 60% of our con to Germany. We took all those LOIs, we've negotiated the terms, we've negotiated or we're almost complete the offtake agreements, and nobody's getting 60% of the con. They're getting 33% of the con. And so those numbers come down. And also the export credit agencies do not actually give you the money. They guarantee the money off of AAA backed sovereign debt from whatever country is under consideration. So our job was to go out and find what we call the MLAs, or the mandated lead arrangers, who actually step over top, do the work, give us the money with the financial backing of these ECAs. And after a full RFP, we brought in SocGen out of Paris as our lead arranger. They've partnered with KfW out of Germany as their co-lead arranger. And also Export Credit, EDC, Export Development Canada, is actually a bank, and they are a direct lender as well. So we stress tested the model. Our CapEx requirement is 1 billion. We're going to fund probably 1.25, maybe a little more. We've talked a lot in the past about cost overruns and inflation and the impact of mining. And, on a 70-30 debt to equity ratio, equity being a whole bunch of different things, just not stock, US 700 million or a Canadian $1 billion is kind of the perfect number for us. And so we've moved forward at that. The first pass work is done. The second pass work is done. All the terms are negotiated. The interest rates are negotiated. The fees are negotiated. And now we move into essentially a period of documentation, which on $1 billion Canadian deal, you can imagine will take a number of months.
Yeah, I'm all too aware at the moment, unfortunately, for me. On another matter, right, let's be clear. So we're moving from non-binding term sheets into a structured debt finance package, right?
Fully mandated and defined, yes.
Got it. Okay, so that's number one. You say you kind of, in terms of those definitions, etc., this kind of structuring, does it have any kind of onerous liens and anything sort of deleterious to possibly, if things don't go according to plan? How protected are you? How defensible is this?
Well, it's probably about as vanilla as project debt as you can get, to tell you the truth. We've seen a number of different term sheets, as you can imagine, in this commodity environment, from fully funded packages, from private equity groups, and this is just standard boring debt. So this is going to be senior secured project that will sit on top of the capital stack. The great thing about this, it's more of a complicated deal, but we have time, right? Our permits are not coming until the end of Q1 into Q2 of next year. So we have a lot of time to go through the documentation and get it right. The tenure of the debt will be tied to the tenure of our offtake agreement. So if we sign a 10-year offtake agreement with Germany, with the Rubis, we get 10-year capital, where most other debt financing structures, they want you to amortize it over 5 or 6 years. Well, we can stretch it out. Gives us a ton of optionality. Also, strategically, what is important to these ECAs at the end of the day is making sure the material gets into their country. So what we're seeing is a lot more flexibility, especially during startup. Because I don't know of a mine that really hasn't had any issue when it's commissioning. And when you carry a large debt package on that project, you want to make sure you build in a lot of flexibility should you hit a bump. And I would say that the way we're approaching it, we're going to be able to accomplish that.
Right. Okay. You say you've got a bit of time, which is always helpful with these things. You're not rushing. You're not under pressure. Super. When do you intend to be able to? When do you hope to be able to kind of advise the market where you've ended up with in terms of the offtake agreements and the debt terms, etc.?
Offtake debt terms are done. They're confidential, but let's say they are sub 10, which is spectacular.
Okay. That's quite good. Yeah,
it's very good compared to other options that are out there in the market. Offtake agreements, we're on the third round. So we're kind of in the final straws. I think we will have financial completion in Q4 this year. But the offtakes, I expect we'll have them done in a month.
Right. Okay. Now, obviously, you'll probably be wanting to sort of, I guess, send some of the banks out and other equity guys and gals out. So when do you think you'll sort of understand what that could look like for you? Because obviously the debt in place takes a lot of risk off the table, certainly with the export credit agency sitting behind it.
Yeah, I mean, if you have 700 in the column, you're still looking for 500, right? And we talked about it 4 years ago, but you probably forgot.
No, I did my research.
You never forget anything. In September of 2020, we bought back our 2.5% royalty from First Quantum for $20 million Canadian. Shareholders weren't incredibly happy at that time. Why is an exploration pre-development company buying back royalties? You should be spending and drilling. That, I like to take credit for it, but it wasn't really my decision. Our CFO said this is a very important thing to do. That's probably going to bring us $400 million US. So, as an unencumbered asset right now with the debt inside, we can now look at the implications of royalties and streams. We have lots of time to do that. We have term sheets in front of us, and again, it is a non-equity dilutive way to fund this. It's project dilutive to a certain extent, but when you're we're up today, we're $160 or $165 million market cap, building $1 billion mine. You don't have a lot of options per se when you have no cash flow. So look for a royalty or stream to come in, and then plus or minus a little equity at the end. But I think the capital stack, as we're lining it up now, should minimize that.
Any strategics looking at this? Did you get money from them?
You're going to hit 500,000 ounces a year in Quebec and a brownfield story that's almost permitted. Probably lots at $3,000 gold. It's an interesting time for Troilus.
It's an interesting time. Interesting optionalities for sure. Let's just come back to that German bit, right? I think people will have heard the word Germany once or twice in this conversation. Why isn't the money coming from the US? Surely the obvious partner in this.
What a leading question, knowing that you're talking to a Canadian right now. Mainly because their hockey team isn't any good. No, I'd rather be lucky than good sometimes. And the way that this project has built out, our project financing over the last year and a half, pre-Trump, pre-election, happened to be east-west, not north-south. Exim USA, their export credit agency, certainly was in the mix. They have copper smelters. They want critical minerals, and 20% of our revenue is copper based, 80% is gold. So I've said it before, copper funds the mine, gold drives the value. We've got the best terms from Europe, and also logistically from where we are in Quebec, Europe's easier. We take our con to the port of Montreal. We get on the St. Lawrence, and we're on the water in a day, rather than training it all the way south. On a cost basis of transport, it's about the same price. So I would also say that Germany and the European Union in general has been far more aggressive on the need for critical minerals over the last 4 or 5 or 6 years. The U.S. is really just talking about it now, and they'll probably get all they want in Greenland.
Okay. How Canadian of you. Right. That's great. Sorry, it made me laugh. Right. Let's talk about some of the other monies involved here. What's going to take to kind of get everything, the kind of financing stack, etc. You got some cash in the bank at the moment. What about $20 million? That sort of level.
We're 20 million. Listen, we're burning a lot of money. We have a couple drills going, but detailed engineering is underway. And so we've contracted BBA, who did Malartic, they did Detour, they did parts of Greenstone. If you walk into BBA's office in Montreal right now, you're going to see Denny Rivard, who we talked about last time, who is our EVP of project development, ran case infrastructure, can build this mine with his eyes closed. But you're going to see 55 engineers sitting there working on Troilus detailed engineering right now. And so the capital we have right now puts us in very good stead, I would say, for the next 6 to 7 months. But looking at these royalty options that we have and call it non-equity options that we're approaching, and including the offtake agreements, the optionality for prepays is quite good. And so our financing plan is fairly solid.
Right. And let's look at things like, obviously, Barnett coming in recently. Your profile's changed. And I think the companies that were able to tell a story in the last 12 months where they're talking about near-term revenue, can show how they get there, show how they finance that thing. I think technically, you guys have done a lot, you've de-risked a lot, but you've still got you still have more things to do. It never ends. It never ends. But do you think that profile that you've built over the past 2-3 years in this kind of boring phase that I always talk about, is that much more attractive to the kind of large institutional cash that you're looking for to kind of drive that share price? Are we going to start seeing more liquidity?
I think so. I mean, if you look at our trading, we're trading well over 1 million shares a day, and that's kind of happened over the last month. So that's a good indicator. And you've talked about it before. How do you break out of the herd, right? There are a lot of 2 million plus ounce low grade deposits around the world, and I've been banging the table on jurisdiction, brownfield, capital intensity, 70% institutionally held. The Quebec government's our largest shareholder, and all of these things. But you have to deliver. And we've been delayed for sure. We've had our delays as well, and our criticisms. But again, we just talked about systematic checking off the box. So, RESIA has been essentially completely reviewed for final submission shortly. That's a huge event. We are permitted and we are actively dewatering. One of our pits is almost empty. So there's pre-development work going on. And then those LOIs in November, I think, kind of hit the market a bit and said, hang on, this could be real. Somebody wants to give them $1 billion. And yesterday, again, it's just another part of the capital stack, which is bringing legitimacy and validity to our asset. The fact that we have brought in the team that we have over the last 5 months as well, a team that's incredibly well known for operating and developing mines. And I think that was probably something we lacked in we had great engineering team, but they're like, okay, who's going to actually build it? We have all of those pieces answered. If somebody asked me that question, we have the answer now. And so for us, to use a baseball analogy, we're rounding third. We have very little permitting risk. We have the commodity price at $3,000 this morning, and the futures in copper at $5. It sure makes things look attractive. I remember when we put out our feasibility 8 months ago, we were criticized for 1950 gold. They're like, why are you using such a high gold price? Well, I think the last feasibility put out in the market was at $2,300 gold. We were criticized for putting the the sensitivity analysis is $3,000 gold. Well, we're there now. So this project makes over 350 million US a year of free cash flow. The Canadian dollar is slumping. That's the other thing to think about. Because of the turmoil with our neighbors to the south, as the Canadian dollar gets weaker, Canadian operations and Canadian gold producers, we're selling in US dollars and our costs are in Canadian dollars. So your margin is expanding. And it is a great time to own Canadian gold producers and Canadian gold exposure, because our 1 ounce goes a hell of a lot further than in other jurisdictions right now. So, and also the general market. I think that VanEck, one of the largest gold funds in the world, they are looking for levered names, exactly to your point of the Artemises, the Skenas, those companies that are, call it, Skena's probably a year ahead of us, Artemis is 2 years ahead of us. And if you look at their market caps, where we were all this exact same market cap. As of yesterday, Artemis is 3.8, Skena was 1.8. And so again, I think what you're going to see is we show this de-risking. Skena quadrupled the moment they had the complete financing package in place from Orion. So, I think we're set to take the same trajectory.
Yeah, you make some good points there. I think obviously I was literally going to ask you about looking back to that study last year. When you're showing an IRR 14% at 1950 gold, people are going, well, okay, not sure about this. At nearly 3,000.
Yeah,
different ball game.
The number after tax, well, before tax, it's 4.8 billion US. After tax is 3 billion US. IRR after tax is 30%.
Right.
Payback's now 3 years. It's spectacular. Yeah.
Okay. We're back in the game. Well, like I said, for us, when we're speaking to companies, there's not too many who've been able to kind of put the financing together. I think it's tell me how you feel about this one. It kind of feels like the old banking structure, conventional banking structure, financing structure for advanced mining plays. It's just not there yet. People are having to get creative. I mean, you clearly have, obviously going to Germany, etc. Do you see more of that happening, or do you think only the lucky few will be able to do that?
Yeah, I mean, that's what I used to do for a living before this life. If we were a pure gold producer right now, even with $3,000 gold, I don't know how we would have financed this mine without a strategic partner, to tell you the truth. I think it would have been almost impossible. With the break in value, or the arb in value between commodities and junior mining at an all-time high, equity used to fill that gap. Now the equity doesn't fill that gap because valuations are low, dilution is too high, and there are not enough buyers anymore. So you're right. I think the old model is broken. Copper concentrate funded this mine for sure, and I think that was a little bit of luck for us, that our timing was perfect with commodity and our wins in our sales, and also with Cobre Panama shutting down. So there is an absolute shortage of global concentrate right now. TCs and RCs are negative. Benchmark pricing for treatment charges are $25. So everybody needs concentrate. So you're right. And you do have to be creative. And that's why, thank goodness for the Orions and the Appians and the RCFs. I mean, yes, their capital's a little more expensive, but they are really filling that hole. And also all the streaming and royalty companies diversifying. All the money is in really that group of hands. It's not really in the institutional investor as much anymore, because the generalist hasn't come back. But when the U.S. generalist comes back, I think it'll be a completely different game, but we're not there yet.
Well, Justin, appreciate the update. It's nice, quick, short, sharp update in this case. Well done on getting that through. I think it's going to make the difference, quite frankly. See you soon.
Thanks, Matt.